What's up everyone? Today we're gonna build a dividend portfolio with $1,000 and we're gonna do this in two ways. One with stocks and one with ETFs. The reason why dividends are so well liked is that they are one of the few true forms of passive income. All you have to do is literally buy the stocks with a click on your phone, and then periodically throughout the year, you get that beautiful dividend without any effort on your side. And this is not the case, for example, with other common forms of investment like real estate, which is a wonderful investment, don't get me wrong, but it's not as passive as most people say. Anyway, in case you're new to the channel, my name is Rick and I make videos on investing and personal finance. And since many of you are dividend lovers, I decided to make this video to talk about how you could make yourself a decent portfolio if you only had $1,000 to invest. We're gonna talk about the pros and cons of starting a dividend investing portfolio, about what to look for when selecting stocks in a dividend portfolio, and finally, based on this criteria, I'm gonna show you a sample dividend portfolio made out of 20 stocks and a sample ETF portfolio made out of 10 ETF. This is gonna be in the form of a Google file that I will make available to all of you, of course, like always, for free, through a link in the description below. So you ready? Let's go right to it. There are actually many different types of dividends, but the one that is probably more interesting for all of you is a cash dividend. Cash dividend is when a company distributes part of the earnings to its shareholders, namely to everybody who owns shares of the company. So with this, we get to the first important definition, which is the so-called payout ratio. The payout ratio is the ratio between the dividend paid by a company and its earnings or profits. So if a company generates $100 million in profits in 2023, and decides to give 50 million to its shareholders as dividends, the payout ratio is 50 divided by 100, 50%. So if you open an account on a trading app and buy some stocks of a company, you officially become a small investor or shareholders of the company. And you also receive dividends periodically if the company pays them. There are some pros and cons of owning a dividend portfolio, so let's see them quickly. Pro number one is for sure the passive income, which is really 100% passive when you own a dividend portfolio. You just buy the underlying security and get paid the dividend every quarter or every month. Moreover, as opposed to the value of your stock portfolio itself, which can only be unlocked if you sell the stocks, the cash you receive as dividend is liquidity and is yours to spend as you please. But if you want to do something right, don't spend it, reinvest it. The second pro is a reduced risk. Companies that pay dividends tend to be more mature and stable than companies that don't. Startups or risky companies instead rarely pay dividends because they blow back all their profits to fuel their growth. For this reason, you can typically enjoy a reduced risk of bankruptcy with dividend stocks, and they usually show less volatility in their share price. The third pro of owning a dividend portfolio is a compounding effect if you decide to reinvest the dividends into it, which, by the way, was my suggestion before. In doing this, you have a double advantage. The earned dividends that you invest are gonna add up to your portfolio and increase its value. And if you've chosen the right companies, the stock value will also grow because of the growth of the company. So everything grows, and also the 3% dividends that you're going to receive in 5 years are gonna be much more than the 3% dividends that you're receiving today. All right, last pro number 4 is that dividend portfolios protect against inflation. Inflation is the increase in prices for all the goods and services that we consume, causing our currency to lose intrinsic value. The last 100 years have been dominated by inflation, which are the green bars here. And between 1960 and 2022, the average inflation rate has been 3.8% per year. On the other hand, dividends have increased at a rate of over 4.2% in the same time period. All right, there are of course also some cons in dividend investing. The first is the slow growth that dividend stocks usually experience. And this is an unlucky consequence of the fact that they are stable companies. Most dividend companies are large cap corporations that are already established and mature, so they don't have so many other ways to invest their earnings, and they prefer to give most of them to the shareholders as dividends. Second, when a company pays out a dividend, after the stock goes ex-dividend, the share price typically drops by the amount of the dividend paid, to reflect the fact that the new shareholders are not entitled to the payment. Third, companies can cut the dividends if they want to. Of course, there are companies that pay dividends for 40, 50, 60 years, so they're not gonna stop so easily, but this is not the case for most companies. And con number 4, except if you have a really large portfolio, let's say it, the dividend you receive will not really make a dent. A good market average dividend yield is 3% per year, so if you want to earn, for example, $1,000 per month in passive income, you'd need $12,000 per year. This gives you a portfolio value of $400,000, which is not impossible, but I guess most of us aren't there yet. But if you do have more than $400,000 in your portfolio, let us know in the comment section below. All right, let's say now that you want to build a dividend portfolio. You open a brokerage account, maybe through Schwab, Fidelity, Vanguard, or maybe through an app like Robinhood or Webull, and now you want to find some good stocks to buy. What are the key components you should be looking for? Since you're interested in dividends, the first thing you look for is a good track history of paying dividends. It's really easy to find out. The website that I prefer for this is macrotrends.net that shows you the history of dividend yields and payout with a graph. A company will be considered a dividend aristocrat if it raises its dividends consistently for at least 25 years, while increasing them for 50 years will make it a dividend king. The second important component is the dividend yield, which is a percentage value. So for example, if you go to Yahoo Finance and look for Bank of America, you'll see that they pay 88 cents per share or 3.07%. Looking at the absolute value, 88 cents here, is absolutely useless. You should only focus on the percentage value. But also the dividend yield is one of those things that can easily become a trap. Not for nothing, companies that offer really high dividend yields and then offer bad returns or cut their dividends are called dividend traps. You have to understand that a company can only grow by using their earnings. So if a company starts giving really high dividends just to convince people to invest in it, they're also not going to have much money to use for their growth. So that brings me to my next point, which is the payout ratio that I mentioned at the beginning of the video. By looking at the payout ratio that you can find in any site such as Yahoo Finance or dividend.com, you can see which percentage of the earnings is used to pay dividends. A really high payout ratio, let's say over 70%, is usually a red flag, and generally speaking, you should avoid it. Other than this, a dividend-paying company in your portfolio should have solid financials. Optimal would be, for example, to have growing revenue and net earnings, but above all, strong cash flows and low debt-to-equity ratio. A good cash flow, and in particular a good free cash flow, means that the company has liquidity on hand, and low debt means they have less risk of bankruptcy. Now, everything I told you so far is important for choosing a single dividend stock, but when you're building a portfolio, you also want to have an eye to diversification. Ideally, you should select 15, 20, 25 stocks that are all dividend-paying stocks across different industries, so that if an industry or a stock goes bad or crashes, you have the others to compensate. Alright, these were the criteria for dividend stocks. What if instead you're interested in dividend ETFs? Well, the first step would be, of course, to subscribe to my channel, because I made different videos about the best dividend ETFs on the market, so you're gonna find a lot of interesting videos there. But apart from that, there are three important factors next to the ones that I already mentioned for the stocks. One is the expense ratio, which is basically the management fee that you pay every year for owning the ETF. Second factor to consider are the holdings, and in particular, the top holdings. You do that to understand the nature of the ETF, the industries covered, and to see if there is a high concentration on few single companies. Third factor is the assets under management. This tells you how much money has been invested in the ETF and gives you an idea of how trustworthy the ETF is. Now, if you want a value, I'd say it should have at least $100 million in assets under management. If you want to know exactly how to choose winning ETFs, with or without dividends, I did a nice video here where I explain step by step how to set up a free ETF screener that will allow you to find and evaluate the best ETFs. And you can follow the video and create the screener totally for free using seekingalpha.com. Check it out if you want, but only after watching this video and dropping a beautiful like. Alright, so now let's look into the dividend stock portfolio. I put together 20 companies here, which are all good and famous dividend companies. And as I said, you're gonna have access to this table completely for free. You can copy it, edit it, whatever you want. I only ask you to be nice and drop a beautiful like to this video. And of course, subscribe to the channel if you haven't done it so far. So now, first, let me explain to you what information you're gonna find here, and then I will analyze specifically a couple of these stocks. Now, in the first column here, you'll find the sector, and you can see it's quite diversified with some stocks in consumer staples, healthcare, energy, consumer discretionary. I also have one REIT, which stands for Real Estate Investment Trust, and so on. Then you find ticker, company name, current stock price that, by the way, gets updated automatically in the file. And here you have a percentage of the portfolio that I assigned to each stock. So I decided the weight of each stock based on my analysis, but of course, you're free to change it as you like, or even set it to 0 if you don't want a stock. Based on the value that you want to invest, for example, here I wrote $1,000, in this column it calculates the amount of shares that you need to buy in order to own that percentage. And then you get the portfolio value that you're gonna have. Follows the 5 years gain, which also gets updated live in the file, and then you have the dividend information that I talked to you about before. You've got the forward dividend yield, which is the dividend yield you can find in sites like Yahoo Finance or dividend.com. You've got the payout ratio, which, if you remember, is the ratio between the dividends distributed and the earnings of the company. And then you have the dividend frequency and the consecutive years of dividend increases. Notice that, except for Bank of America, which didn't increase the dividends 2 years ago, all the other companies have a solid history of dividend increases, with companies like Johnson & Johnson and Procter & Gamble going even over 60 consecutive years. Then on the right hand, you have the average yield of the sector, which you can use to see if the company is paying better or worse than the average. And lastly, the expected yearly dividends with this configuration. In my case, we're talking about $32.81 for $1,000 invested, which means 3.28% average dividend yield. I want you to also notice another detail. The payout ratio is generally in the range 50% plus minus 20%. The only exception here is realty income, which has a payout ratio of 212.95%. So now you might wonder, how is it even possible to have a payout ratio that is higher than 100%? That would mean that they managed to pay in dividends much more than what they earn. And the interesting thing is that realty income has been able to do so for the last 15 years. So how is that even possible? Well, real estate investment companies have a different financial model than standard companies. They claim a lot of depreciation every year and have a lot of other non-cash factors like big purchases of new buildings, so their earnings will actually appear lower than what they actually have. If you wanted to calculate the real payout ratio of a real estate investment company, you should use the so-called funds from operation, FFO, instead of the profits. And in this case, you'd see that based on an FFO per share of $4.23 and a dividend per share of $2.97 per year, actually realty income has a payout ratio of 70%. Still, I decided to give realty income only 4% of the portfolio because after more than a decade of low interest rates and treasury bond yields, in which most investors turn to dividend stocks like realty income, the scenario we developed in the last 2 years with high interest rates to fight inflation actually allows us to get better yields from lower risk assets. So less investors are now ready to risk so much in REITs. Another company that I want to quickly talk about, also because it's a particular case like realty income, is 3M Corporation. Here probably you can notice right away that the company is down 51.97% in the past 5 years, and if you check the performance of the last 10 years in Yahoo Finance, well, it doesn't really look well. Still, I included it in this portfolio. Why? Am I crazy? Probably. Yeah. I didn't think of that. But there are other reasons for that. Since we're talking about over 50% loss over the last 5 years, we ask ourselves, is it something that 3M is going to recover from? Well, of course, we don't know for sure. But I can tell you what are the reasons that caused this crash and what are my thoughts about it. One reason is that 3M during the whole COVID period benefited from increased masks and protective equipment demand, but this ended in 2022. Another big problem is the ongoing litigation alleging that its earplugs caused hearing damage for more than 230,000 people. And the company is also facing lawsuits because of some chemical compounds they produce, which are known as forever chemicals, and allegedly cause health problems in some communities. If you ask me, these litigations and lawsuits are often problems that big companies eventually overcome, so you could even profit from this current low price. Nevertheless, nobody knows when they're going to be overcome, so if you don't have diamond hands or don't want to hold the stocks for at least 10 years, I can't promise anything. Alright, I haven't talked about the ETF portfolio and I don't want this video to be too long for you. But you'll find the portfolio in the same file that you can access through the link in the description below. Maybe it's worth mentioning though that here the columns are a bit different. I have added, for example, the expense ratio, the year-to-date gain, and I removed also some other things that you don't really need here. The ETFs that you find here are all ETFs that I talked and will talk about in my channel. So the best thing you can do is to subscribe to my channel, because in the future you'll get other videos like this about ETFs and stocks. If instead you want to see one now, you can watch this, which is the list of the 5 best dividend ETFs to buy in 2023. And here I go more into detail on the ETFs. If you have any questions on money or personal finance, I'm glad to answer whatever you like to ask, so you can always leave me a comment on the comment section below. I hope you guys found this video valuable. If you did, make sure to like the video and also subscribe to my channel and click the notification bell, because you'll get notified every time I drop a new video. Feel free to follow me on Instagram and TikTok as Dago. And other than that, guys, I wish you a great evening, and as always, I'll see you in the next video. Ciao.